Hi. Instruments that record, analyze, summarize, organize, debate, and explain information, which are illustrated, non-illustrative, hardbound, paperbound, jacketed, non-jacketed, with forward, introduction, table of contents, index that are intended for enlightenment, understanding, enrichment, enhancement, and education of the human brain through sensory route of vision and sometimes touch. Books. So, why did I quote this dialogue? First of all, because there are two ways in which this presentation can go on from this point of time. One way is I can brief you with all definitions in the books, and the other way is I can get into the fundamentals of the topic and address you with each minute details of it. So, yesterday, Mr. Xavier, sir, told us that the expected result of this event is learning, training, and advanced training. So I believe that it is in the best interest of the crowd that we go with option number 2. Respected dignitaries, judges, and my respected fellow friends, namaste. I am Keyur Manyar, a second year article and more importantly, a CA final student like y'all, and I am here to talk about internal financial controls. So the agenda for my presentation is first, like always venturing into a new topic, we always look into the meaning and definition of the concept, right? But today I'll do something new. I'll give you the meaning of the definition. After that, we'll look into what are the statutory requirements of the Companies Act 2013 for internal financial controls. Then we'll be going into what are the forces that you can use for as a guidance, as a reference when it comes to IFC matters. Next, IFC process. What is the actual process? What is IFC all about? After that, we'll move on to how an auditor has to form an opinion based on the IFC, and then what are the impact of the auditor's opinion. First of all, what is IFC? Well, as you can see on the left-hand side of the screen, there's this definition, which I'm not much interested to go into the depths, but I can tell you, to summarize the definition, it can be divided into 3 parts. IFC are basically controls which can be broken down into 3 components. One, the IFC over financial reporting, other the operational controls, and fraud prevention controls. Now, first of all, what are controls? And what is the scope of IFC? Basically, I would like to tell that SOPs, have you heard about SOPs? Yes, SOPs are a type of, or you can say are an application of IFCs. बहुत boring हो रहा है? Okay. So, first of all, I think we should applaud that we are all here in spite of all these rains and everything. And we have been sitting through 2 days of rigorous technical sessions and motivational sessions as well. Well, कुछ लोग यहाँ पर तैर के भी आए हैं, मैंने सुना. बाकी लोग मेरी तरह ट्रेन से आए होंगे, ऑटो से आए होंगे, ट्रेन से आए होंगे. तो कितने लोग ट्रेन से आए हैं? ओके, क्वाइट अ फ्यू. तो मैं रहता हूँ कांदीवली में. कांदीवली से यहाँ पर आने के लिए, कांदीवली स्टेशन से भाईंदर स्टेशन आने के लिए एक स्टैंडर्ड ऑपरेटिंग प्रोसीजर है. मुझे टिकट निकालना पड़ेगा. आफ्टर दैट आई विल हैव टू बोर्ड द राइट ट्रेन and then get down and then leave. So this is basically what an SOP stands for. It is an operating procedure which is standardized so that there are no less loopholes in it. Next, I would like to shed some knowledge about IFC over financial reporting. These are those SOPs or those controls which are mainly related to your financial reporting, your financial statements, such as your control over your debtors will fall into this category. Other than that, we have other business processes which do not get directly reflected into your financial statements, like purchase orders. So your controls over your purchase orders will directly be classified into the operational controls. And then there are fraud prevention controls as well. A very basic example would be a KYC procedure, which is established so that frauds can be prevented. Now let's move on to the statutory requirements. What does the Companies Act 2013 say about IFC? Well, in a gist, it gives us 4 directions. Section number 134 of the Companies Act 2013 gives us the responsibility of directors. What they have to do is, they have to give an assertion that they have laid down proper IFCs, and that there are adequate controls which are being operated effectively. Next, section 143 states that the auditor's report should contain an opinion on the adequacy and the operating effectiveness which the director's report had. Next, section 177, the audit committee is expected to call for comments and other recommendation from the auditors. Schedule 4 of independent directors expects the directors to satisfy themselves with integrity over IFCs. Basically, they have to establish that the IFCs are robust and defensible. Moving on to what are the guiding factors of IFC? Where do you see the procedures of, what are the guiding forces of IFC matters? Well, there are 3 primarily. First is a guidance note which is issued by our MyBAP, ICAI, in 2015. Next, we have Companies Act, which we have already seen what are the statutory provisions. And then we have a standard on auditing, 315, as explained by Sudhanshu also, which also has what internal controls mainly feature. Next, what is the IFC process all about? What are the roles and responsibilities of each party included? So, well, I would like to present it in a very simplified manner and not getting into much details, because the guidance note is about 200 pages and I don't want you all to suffer with that, because we don't have much time. It is a beautifully worded guidance note, but since we don't have that much time, I'll give you a brief about it. So there are 2 major roles, one of the management and then of the auditor. What the management roles include are, they have to identify what are the significant items in their financial statements or what are their significant accounting processes. Next, they have to understand what are the significant flows of transactions in such processes. Then they have to identify what are the risks involved in each processes which can result into material misstatement. After that, they have to identify or establish controls that can address each element of risk. Next, finally, they have to implement what controls they have established or identified. So these are the role of management. Auditors, what do we have to do about it? Well, we have to carry out two major tests, because we have to give an opinion on the adequacy of controls and the operating effectiveness. So the adequacy of controls can be tested by the test of design, in which we test the design of the controls, how they are set up, are they adequate to mitigate the risk of material misstatement. Next, we carry out a test of effectiveness, in which we take out a sample of the process and walk through, which I'll show you in the next few slides, what is actually walk through and what do we actually do in practice. Then we assess what findings, what outcomes have come out these 2 tests, and we assess the impact of those findings on the audit opinion. Such audit opinion of IFC will also impact the audit report, which is the audit opinion on financial statement. So that also should be assessed well. Now, this is an example wherein I have a company which I have found out that the significant items or processes are 3: creditors, debtors, and staff salary. Now I want to focus upon debtors first, because I think that is the most major area of my business. Now, related to debtors, what can be the major transactions? What can be the major flow of transaction? Well, in my business, there is sales, collection, and discount, and collection forms the major part of it. So below, I've given a table which describes how this process of IFC works. what does the management do, and then what does the auditor do about it. So the management has to prepare a risk matrix in which they have to identify what are the risks associated with each process and list them down in the risk of material misstatement column. As you can see, the item is daters, the process is collection, and there are two major risks of material misstatement in that. One is the untimely check remittances to HO, which basically means that if I have a branch somewhere, they are not remitting the checks properly on time. So that will affect my cash flows and other major processes of my business. Next risk that I have identified with basis of collection is the unauthorized collection expense. Vasuli ka kharcha. So only those expenses that I have authorized should be expensed and not others. So this is also a risk of material misstatement. Now what are the controls that the management has identified or established against such risks? Before moving on to that, there's another process of discounting, giving discounts to the daters. Well, that also has a risk of material misstatement in excess discounts, giving excess discounts than what have been authorized. So now what are the controls that the management has identified? For the untimely check remittances, management has set up a system wherein bi-weekly check remittances happen to the HO, which means at the max, 3 days or 4 days outstanding checks can remain with the branch, and then they have to compulsorily be sent to the HO. Next, for the unauthorized collection expense, reimbursement of such expenses are to be made only on the basis of standard operating procedures, SOPs, remember, and the attached vouchers, which basically give an audit evidence. Next, for the excess discount risk of material misstatement, they are deducted from the salary of the discount giving employee. Like he has given excess discount than what was required, right? Then the management asserts that whether there are controls implemented or not. So obviously management will say yes, right? So this is the work of management. Now let's see what auditors have to do. So the above table is the same which we saw, and the below table is what we do in practice. So this is actually what we do, how we walk through processes and test for design and effectiveness. So in the collection problem, in the untimely check remittance to HO, the kind of test that we performed is inquiry, because we inquire to the branches and then try to get a walkthrough of it. So the walkthrough procedure has worked like this. We had selected a check number 000XX, which was received on 16th of February 2018, and we have seen when was it actually remitted to the HO. Now in this case it was 2 days. So yes, we can say that, we can form an opinion, yes, there are adequate controls as well as the controls are effective. Next, there's another problem in the collection of unauthorized collection expense, for which we carry out inspection procedures. Now for the walkthrough, we have selected employee 02XX. He had paid rupees 2000. We had paid rupees 2000 to him, pardon me, and the vouchers that he had submitted to us worth rupees 600 only. So in this case, we can say that yes, there are controls in place, but they are not effective. They are ineffective. Next, similarly, for the discount risk of material misstatement, we can perform the observation test and select a product and discount allowed as per the SOP. Auditor's opinion. Well, we know, right, there are two major kind of opinion which an auditor can give, which is an unmodified and modified opinion. So what forms the basis of the opinion remains rather the same things: adequacy of the IFC and operating effectiveness of the controls, and not what the management had asserted in its responsibility statement. What are the impact of the auditor's opinion? Well, monetary consequences include a section 134 contravention, which is a fine of 50,000, to rupees 25 lakh, and an imprisonment up to 3 years. Non-monetary consequences include management had to be put under question, the company will lose its goodwill and market value, and also negative notions about the company will flow through the market, and the company will suffer a loss of business. Now to conclude, I would like to summarize this topic, but then I would require your help to summarize the topic. This is a crossword. We have 7 words that had been placed in my presentation, and I need you all to find some. One by one, please. Opinion, control, Risk. Anyone from there? SA 315? Report, you know all the answers, I know. Anyone else? IFC, there's one more word, which is an abbreviation only. Risk is done. ICFR. So we have all the 7 words, and I'd like to quickly summarize. What is IFC? Internal financial controls are, you can understand them by understanding SOPs. What are ICFR? They are a part of IFC. They are basically controls over the reportings. Risk, we know what risk is. Control is the setup that we have put in to mitigate such risk. SA 315 guides us with internal controls. We can form our opinion on the internal controls and then put it in our audit report. So this is me signing off. Thank you so much for being a wonderful audience. Thank you, judges and the dignitaries. Thank you. Jai Hind.